So it's the midterm review today. I hope that your studying has been good as of right now. And also I hope that you're not finding the class too difficult or too overwhelming. I think you already got some assignments, I think 2 already. I hope they went well. They're really good practice for your midterms because normally they're past the exam questions, or they're really similar to what you're going to see on your exam. So if you have some difficulties with them, just like redo them, check the solution, make sure that you understand where you make your mistakes. Another thing about the midterm is that not to discourage you, but normally the midterm questions and topics are easier than what you're going to see on your final. So if you're able to score high for your midterm, then it's going to be a little bit of a relief for your final when it comes to time to do the exam. And another tip just for studying is really just practice. Do your chapters problems, do the, I think they posted the exams on the Moodle, so do the past exams. I also, last semester, I was doing weekly, so every week I would do past exam problems. So I think you can all see those on the Facebook group. So if you want more practice, you can go there and check it out. So we'll jump right into chapter 13. So chapter 13 is about current liabilities. There's a lot of different little questions that they could ask for, but I find that it's you do a couple of problems on each, and then after that you're good for the final. For the midterm. There's not many ways they could ask you a question on those topics, so normally you kind of see the pattern after a while of what kind of questions they ask. I'll skip over the definitions and everything, but the PowerPoints are all on the Facebook group if you want to go and look back on this. Yeah, so we're basically going to talk about financial liabilities, non-financial liabilities. This chapter is more on current liabilities, so liabilities that you have to settle within a year of the cycle. And here's some example of liabilities that you might see on your exam. First one being callable debt. So that happens when the issuer of the debt can ask at any time the repayment of the debt. So that means that at any time you could be using your cash to pay back that debt. So it's always going to be classified as current in your financial statements because it might be funded out of your current assets, even though you expect maybe to pay it back in 3 years. So you're placing it as a current liability in your statements, and then you're going to disclose in your notes for your users when you think you're actually going to pay it back. Callable debt might be an issue also when you have covenants for your long-term debts. So, for example, you have a certain ratio that you have to uphold to keep your debt. And if you break that ratio, then the bank may ask you to pay it back right now. So the debt may become callable. And with that happen, under IFRS, after you break your ratio, so when the debt becomes callable, you're always going to classify as current, even if the bank is it's okay, you will need to pay it back, they give you a waiver. And that's because at the date of the statement of financial position, the company didn't have the right to defer the payment beyond 12 months. So they couldn't say oh, I think I'm not going to pay it for the next 12 months. So they're going to put it as current. Under ACCO, it's going to be a current liability unless the bank tells them, okay, it's fine, you're not going to need to pay it back. And it has to be done by writing. That's what's in the standard. Or they have fixed their ratio. So let's say that they broke the ratio on January 2nd, and then January 17th, the ratio is back on and it's fine, and it's not breaking the covenant anymore. Then they can keep it as a long-term liability. And also, so it's one of these two, and they don't think that they're going to break the covenant in the next 12 months. So they fix the ratio, and they don't think that in the next year they're going to break the ratio again. Another topic is short-term debt expected to be refinanced. So when a debt comes to maturity and you need to pay it back, normally that debt is going to be classified as a current liability because you're going to pay it back in the next year. But a company might expect that the bank decides to refinance it. So that means that they're going to issue a new term and you're not going to have to pay it back because that new term is going to take into consideration your old debt. So the company may be tempted to put it as a long-term liability because they're not going to use their current assets to pay back for it, and it kind of ruins their ratios, especially current ratios, and it's not really a good look on their statements if they have like a 5 million in their current liabilities and they know that they're not going to pay it back. So it's more like, how do you classify that debt at the date of your statements? Short-term, long-term, it depends. Under IFRS, it's always going to be reported as current, so short-term, even if there's been the long-term refinancing agreement that's been made before the financial statements are released. So even if they know before the statements are released that they're not going to have to pay it back, they still need to classify it as current. The only exception is this here. For continuing long-term classification at the date of this statement of financial position, the entity expects to refinance it or roll it over an existing agreement for at least 12 months, and the decision is solely at management discretion. So basically it means that on December 31st, if that's their year end, they already have another loan and they expect it to roll it over that new loan. But in problems, like, you need to have like this sentence in your problem. And if it's not there, then you're going to put it under current liabilities. For ASPE, it's a little bit more, it's always more chill with ASPE compared to IFRS because it's private. So there's not the whole world can see the statements. Normally it's only used by banks. So under ASPE, it's also going to be classified as current liability, unless you have like evidence that before the statements are released that your short-term debt is going to be rolled over and new long-term debt. So that happens if you already have the refinance agreement and it's been signed and settled before the issuance of the statements. And yeah, so basically the refinancing needs to be done before the statements are released. If the long-term debt is lower, that the new debt that was issued is lower than the old debt, the amount that you can put in your long-term liabilities is only as much as your new debt. So your new debt is 5 million, your old debt that you needed to pay was 7 million. You can only put your 5 million in your long-term, and then you're going to put 2 million as current. Is that clear? Do you guys have any question? As of right now, I think I'm going a little bit fast, so you can just stop or write in the chat if you have questions. Yeah, Jonathan?
Yeah, I'm just wondering, does it have to do with the timing too? Like, the refinancing is before the publishing of the financial statements, whereas IFRS is like before the ending balance or something? That's
Yeah,
how we remember from class.
yeah, it's exactly that. So under ASPE, your refinancing needs to be done before the statements are issued. And under IFRS, you need to have your refinancing or an existing loan at the date of the financial statement. So at December 31st, if that's their year end.
Okay, thanks.
Also, I'm sorry about my voice and like how I'm acting. I'm just recovering from COVID, so I'm a little bit out of it. So sorry, normally I have more energy, and it's also 9 a.m. on a Sunday. So another liability is asset retirement obligation. So for me, when I took the class, for some reason that was like super vague, and I didn't understand it. But it's normally like construction companies, oil companies, they use like the earth to do their operations. So they have long-lived assets. So oil company is going to have an oil rig to like take out the oil from the ground. Like mines they have to go and search the mines for whatever they're searching for. So using those assets means that you're going to incur costs at the end of your exploration or use of those assets that are normally required by the government. So those costs needs to be taken into account when you first start using your asset. And you're going to record them as an asset retirement obligation in your liabilities, because you know that in like 20 years, you're going to have to pay 500,000, let's say, to put back the site or asset or whatever it was back to its good condition. The slides are already on Facebook. They're not all together, but you can go into the files of the Facebook group and check for the PowerPoints for chapter 13, 14, and 16. I just put them all together, but they're already there. So here is like some examples. So yeah, so the obligation, like the amount that you think that you're going to pay in like 20 years to put back the site as normal, is going to be recognized the day that the exploration begins. So you're going to present value that amount in your statements, and at every year you're going to increase it by the interest amount. So like a long-term debt, because I can say that because you've already seen it, but like a long-term debt, you're going to like amortize the obligation. So IFRS recognize both legal and constructive obligation, and ASPE only legal obligation. So I skipped the definition earlier, but legal is obligation is anything required by the law, and constructive obligations is anything required because of the company's action. So if there's no law, but they've always cleaned the site after, then they're still going to put in their books like the cost of cleaning the site, even though it's not required by the law, because that's what they've been doing is historically. The journal entries for IFRS and ASPE are pretty similar. The journal entries, it's just like sometimes the account names change. You're first going to capitalize the asset when you buy it. So you buy an oil plant, you're going to capitalize it in your books like you've seen in the past two like financial reporting classes. And you're also going to recognize your arrow, and that arrow is going to add to your asset book value, and you're also going to increase your liabilities here with your obligation. And that's because, I don't know if you remember for ACCO320, but any directly attributable costs when you buy your asset are going to be included in your asset cost. Does that make sense? The arrow amount that you're going to put here is the fixed portion. So it's the portion that, regardless of what happens during the production over 20 years, you're always going to have to pay a certain amount at the end. You're also going to have like a cost of arrow that might happen throughout the years because of production. So that's more like your variable cost. So that may fluctuate from year to year. So at acquisition, what you're recognizing is really the fixed portion, what you think you're going to be paying at the end, just because you put the plant, the oil rig plant there at first. So for the variable costs that you have ongoing throughout the years, for IFRS, I'm going to put it under overhead, and then it's going to increase your arrow. So that really depends on how much is produced. And then under ASPE, you're going to add it to your assets, and then your arrow. And the difference is because if I remember correctly, under ASPE, you don't have manufacturing overhead. You don't have the split of direct materials, direct labor. It just all goes to your asset. And all capital costs, so are amortized over the life of the projects. That means that you're going to have an interest expense that you're going to have to recognize every year for your arrow. And you're going to present value your arrow at acquisition. Then you use so when it's at each end of the year, you're going to recognize your interest expense for IFRS and acquisition expense. which is based on the effective interest method. So like a loan, you're going to amortize it to get at the end to your future value in your books. Over the 20 years, you might realize that, okay, I thought it was going to be $1 million. I thought it was going to cost me $1 million, but actually I think it's going to cost me $5 million. And when that happens, you need to account for the change in estimate in your books. So what you're going to do is you're going to present value your $5 million to the date that you realize that you're going to have to change your estimation, and you're going to have your book value of the arrow, and you're going to book a gain or a loss depending on the difference between the two present values. And at the end of the life of the asset, normally you're going to pay for the restoration of the site. It might be different than what you were estimated. So you estimated it was going to be 5 million, but it's actually 4 million. So you're going to remove the arrow from your book of 5 million. You're going to have your cash of 4 million, what you actually paid. And then in this example, you're going to have a gain of $1 million because it cost you $1 million less than what you estimated. Any question for arrow? We're going to do an example, but okay, don't hesitate if there's one that pops in your head afterwards. Product warranties. There's two types of accounting for product warranties, and normally it's going to tell you in the problem which type the company uses. There's the expense-based and revenue-based. Expense-based means that you cannot buy the warranty separately from whatever was bought. So let's say I bought a laptop for $500 and it comes with a 1-year warranty. I cannot not buy the warranty, it comes with it. So when that happens is you're going to record your sales revenue for the $500 of your laptop. You're going to record your COGS for the laptop. And then after that, you're going to estimate how much that 1-year warranty is going to cost you. So your estimation of the cost of the warranty is going to be booked into a warranty expense, and you're going to have a liability for your warranty of what your estimation is. And when you actually incur the cost, like the actual cost of the warranty, you're going to come and reduce the liability that you had set up at the time of sale. And the other leg of your journal entry is going to be cash if they pay cash, or inventory if they replace the laptop. For revenue based, you can buy the warranty as an add-on to whatever you bought. So I bought my laptop for $500 and I decided to buy a 3-year warranty for $100. So that is separate from your laptop. So it's going to be accounted for separately. The $100 revenue from the warranty is going to be put as an unearned revenue because and it's going to be recognized as revenue when the warranty is actually used. And the warranty expense is going to be the actual cost of the warranty. So your estimation, if you want, is your unearned revenue. So whatever they got. And then when the clients actually use the warranty, you're going to recognize your sales revenue for the warranty, and you're also going to recognize your warranty expense. So the difference between the two approach. So the liability under the assurance type, I think it's the expense type, is the estimated cost. And under the revenue approach for service type warranties, the liability recognized is measured at the value of the service to be provided, so not at its cost. So your unearned revenue is the sales value, whereas your warranty liability under the expense approach is an estimation of what it's going to cost you. So your unearned revenue is not what you think it's going to cost you, it's what you sold it for. And under the expense approach, there's no effect on future income because you don't book it into a revenue or unearned revenue account. Whereas under the revenue approach, it's going to affect your income in the future when you're actually delivering the warranty services. Premiums and rebates. So if you go to coffee and there's like a program where like after you buy 10 coffees, you get like a free mug. That's what we're talking about here. How do you account for it? It's normally accounted under the expense approach, but it can also be accounted for under the revenue approach. So it's really similar to warranties. And the obligations existing on the date of the statement of financial position must also be recognized and reported in a liability account. So that's kind of the same just as any liabilities, really. So yeah. And finally, contingencies. It's when you have like a situation that arises where you don't really know how it's going to go. You don't really know if you're going to have to pay money. You don't really know if you're going to get money. You don't really know if you're going to have to pay in a set. So you're kind of like unsure of what's going to happen with that certain situation. The most common example is lawsuit. The lawsuit takes a while before they're settled. So in that meantime, you're not really sure if you're gonna get the money, receive money, pay money. So within the time of indecision, you're gonna have to either account for it. So if you want to account for it under ASPE for a lawsuit, for example, where you have to pay like, I don't know, you might have to pay like $100,000. You're gonna recognize that contingent liability only if it is likely that only if it's likely that you're going to lose the lawsuit, for example. So likely means more than 70% chance that you're going to lose the lawsuit. When that happens, you're gonna record it, and also that you can reasonably estimate the amount of the lawsuit that you're going to have to pay. So in that case, I think it's likely that I'm going to lose the lawsuit, and I know I'm going to have to pay $100,000 if I lose the lawsuit. So the both conditions are fulfilled. So in that case, I'm going to record a contingent liability in my financial statements and also a contingent loss in my net income. If it's a range for ASPE, so if you think that, I don't know, they give you a range of like 100,000 to 500,000, and they don't tell you like one number between that range that is more probable, you're gonna put in your statements the 100,000, and you're gonna disclose in your notes 400,000. Say like I might also need to pay like 400,000 more depending on how the lawsuit is settled. That's additional information notes. You can read it if you want. Under IFRS, you're not going to book a contingent liability. You're going to put a provision for liability, because I put like Y here, but basically just like be careful when writing your exam. I think it's still multiple choice. Correct me if I'm wrong, but if they put like contingent liability and then provision for contingency, just be careful whether it's IFRS or ASPE, because under ASPE you can put contingent liability, whereas under IFRS you have to put a provision. And under IFRS, you're going to recognize the provision for present obligation if it is probable, so 50% chance or more that you're going to lose a lawsuit, for example. So here it's 50%, under ASPE was 70%. And same second criteria is that the amount of the obligation can be measured with sufficient reliability. And the difference here is if a range is given, you're going to do a weighted average of all like of the range and the probability of the amount of each value in the range. Any questions on the theory of chapter 13 before I jump in the problems? Is it big enough? Can you guys see if I type it? We'll take it as a yes. Thank you. So the first question is on short-term refinancing and callable debt. So on its year end, December 31st, 2021, Home Corp had a debt outstanding of 1.5 billion with TD Bank that was due on April 25th, 2022. Home Corp entered into a financing agreement with Gardens Bank on January 17, 2022. The agreement stated that Home Corp could borrow up to 70% of its account receivable balance for the year. Home Corp is expecting to have a balance in its accounts receivable varying between $2 million and $5 million. The amount borrowed will be payable by Home Corp in 5 years. The agreement with Gardens Bank requires that Home Corp keeps the debt to equity ratio of 1 or lower. If Home Corp breaks this covenant, they have a month to rectify the situation or they have to repay the debt immediately. Home Corp has decided to borrow under Gardens Bank agreement and repaid its debt outstanding with TD Bank on January 25th, 2022. Home Corp financial statements were released on February 27, 2022. Required, assume Home Corp uses ASCII, how would they classify their debt with TD Bank on their balance sheet at December 31st, 2021? And then same question, but if Home Corp uses IFRS. So we'll start with ASCII. Oh, hold on, my Excel is bugging. So best way to solve for this type of problem for ASCII is to use a timeline where you're going to put the year end, you're going to put when they entered into the refinancing agreement, when they repaid the short-term debt, and when the financial statements were released. So anyone can tell me what date was the year end of Home Corp? Yeah, Jonathan?
Is it December 31st, 2021?
Yeah, exactly. So their financial statements are going to be dated December 31st, 2021. When did the refinancing agreement took place, sorry, with its Garden Bank? Yeah, Jonathan?
Is it January 17th, 2022?
Exactly. And the amount here, we don't give us like, okay, the amount is fixed for the new debt. They gave us a range between 2 million and 5 million. So what do you think? Do you think it's going to be 2 million? Do you think it's going to be 5 million? Do you think it's going to be an average between the two? Anyone has any ideas? No. So here, because it's a range and it's a range based on future balance, so you don't really know what's going to happen in the future, you're always going to take the lower amount here, the 2 million, because that's the only amount that you're 100% sure that you're going to hit, because it's the minimum of your range. Whereas the 5 million, it's the maximum, but we don't know if during the year they're going to hit the maximum. So for this problem, you're going to take the 2 million. And it says that it's going to be 70% of its accounts receivable balance. So it's going to be 70% of the 2 million. And it is $1.4 million. So that's going to be the amount of the new agreement. Did Home Corp repay their short-term debt? And if so, when did they repay it? Yeah, Jonathan.
Is it January 25th, 2022?
Yeah.
When they repaid it?
Yeah, so they repaid their debt on January 25th, 2022. And the financial statements were released on February 27, 2022. So under ASP, the two question you need to ask is, was the short-term debt refinanced with a long-term instrument? Answer here is yes, because the new debt is due in 5 years. So yes. And was the refinancing done before the financial statement release? So here you come and look at your timeline. Refinance was done on January 17, 2022. Financial statements were released on February 27, 2022, so that's fine. But you also have to look at the repayment date because it needs to be after the refinancing agreement. Because if the repayment was done here, on January 1st, let's say, then they would have used their current assets, right? So if they're using their current assets to pay back their debt, then they can't put it as long-term liability because they're using their current assets. So they're going to have to put it as a current liability. Was that clear, that little point here? So that's why you also have to look at, is my repayment of the short-term debt done after my refinancing agreement? So both of these little criteria are yes. So you're going to be able to place an amount in your long-term liabilities. So the amount that you're going to put, yeah, Jonathan?
Can you repeat that? I couldn't quite understand why the repayment debt is important.
Yeah. So the repayment of the short-term debt was done on January 25th, 2022, which is after the refinancing agreement. And I think they also mentioned that they repaid their debt using the Gardens Bank agreement. So because of that, then they didn't use their cash to pay back, they used their new long-term debt. So that means that they used a long-term financial instrument to pay it back. If they had repaid their short-term debt at any point between their year end and January 17th, so January 1st, they would have used current assets to pay it back. So they would have used cash most likely to pay it back. And that means that because they're using their cash, they're gonna put it as a current liability, because current liabilities normally is because you're gonna be using your current assets to pay it back. So at December 31st, they won't be putting anything in their long-term liabilities because they actually use their current assets to pay it back. So they use current assets to pay it back, they're gonna put it as current liabilities. Okay. Was that clear?
Yeah, thanks.
No problem. So in their current liabilities, they're gonna still have short-term debt here. And in their long-term liabilities, they're gonna have, well, a portion of the short-term debt also. So that's at December 31st. 2021, right? We're looking at December 31st, 2021 on their balance sheet, what they're gonna put. They're gonna put in their long-term liabilities, they're gonna put the amount that they got from the bank. So the 1.4 million. You cannot put the whole 1.5 million because they didn't get 1.5 million. They got a lower amount from the bank than what they actually owe. So that means there's 100,000 that they're gonna have to pay back using their current assets during the year. If they got from the bank 2 million, then they could have put in their long-term liabilities the full 1.5 million here because the amount was greater than what they owed with their old term. All right, under IFRS, is there a mention that at December 31st, 2021, management expects to refinance it using an existing agreement? The answer is no, there's no mention of it in the column. So you're gonna put the whole thing in your financial statement at December 31st, 2021 in your long-term liabilities. So IFRS, I find for this type of fraud, it's all a little bit easier because it's more strict. So you're kind of just, oh no, sorry, current liabilities. I don't think so. You're putting the whole amount in your current liabilities because this is not required. So you don't have any long-term instrument to roll it under at December 31st, 2021. So IFRS is always a little bit more easier for this type of problems, and also like they're more strict, so it makes it a little bit easier. Depends how you see it. So we stopped here. So for the following questions, assuming that it is now December 31st, 2023, Home Corp has broken its covenant of the debt with Guardians Bank because it has a debt to equity ratio of 1.3. Home Corp has rectified the situation on January 17, 2024, and does not think it will break the covenant again in the next 12 months. The financial statements for the year ended on December 31st, 2023 were released on March 3rd, 2024. So they're asking the same question as earlier. So how would you classify it under ASPE and IFRS on the balance sheet at December 31st, 2023? So for ASPE, there was 3 little requirements that you had to look for callable debts. The first one was, did the creditor waive, did the bank waive in writing payment requirement, or was the violation rectified within the grace period? And then it's not likely that the company will violate the covenant requirements within a year of the balance. So here, did Guardian Banks waive in writing the covenant requirements? No, there's no mention of it in the problem. They don't say anywhere that Guardian mentions like it's fine, you don't need to pay us back. But it did say that Home Corp rectified the situation on January 17, 2024. And the grace period of Home Guardians Bank was a month. So that was fulfilled. So within a month, they fixed the ratio to fit with the criteria of the covenant. And is it not likely that the company will violate the covenant requirements within a year of the balance sheet? Yeah, it is not likely because they don't think it will break, like it says it word for word here. So that means that the callable debt, if there was a no here or a no here, the callable debt would have been classified all as current. But because it fulfills like the little criteria here, the company can continue to classify it as a long-term liability. Here's 1.4 million. I'm not taking into account like the interest and present value, it's just like round number, just so I know. And then under IFRS, it doesn't matter, it's always going to be classified as current liability because they broke their covenant. So you're going to put the Guardian's debt, all the amount as a current liability. Any questions on callable debt? Yeah, Jonathan?
It's maybe a stupid question, but what does waive mean?
It means that they're like, okay, you don't like they remove the covenant, like they don't, the company doesn't have to fulfill the covenant requirements anymore. It's not an obligation anymore.
Okay, thanks.
No problem. For question 2 is about ARO, asset retirement obligations. Barrel Industries bought an oil platform on January 1st, 2021 at a cost of $2.5 million. The platform is expected to remain in use for a period of 10 years. After the 10 years, Barrel Industries is legally required to dismantle and remove the platform. The total cost of dismantling and removal is estimated at $650,000, with 20% caused by the platform in production accrued at the end of the operating year. Barrel Industries uses a 7% discount rate, straight line amortization, and has an operating year ending December 31st. Prepare the necessary entries to record the acquisition of the platform on January 1st, 2021 under IFRS and ASPE. So acquisition. So what you want to record at acquisition, you want to record the asset that was bought, and you want also to record the fixed portion of the arrow at its present value. So first, the asset that they bought is a property, plant, and equipment, and it is an oil platform. And the cost is $2.5 million. And let's say that they pay cash for it. So that's to capitalize the asset. Then you want to record your arrow. So the arrow at first, when you first recognize it, is going to increase your asset value. And you're also going to now create your asset retirement obligation account. You're going to want to find the present value of the fixed cost. So here they said that they estimate that it's going to be $650,000 with 20% caused by the platform in production. So here it's like your total cost. So it includes your fixed cost and your variable cost of the production of oil. So here what you want to book is only the fixed cost. So you're going to have to take out of the $650,000 the 20% here. So it's going to be $520,000 that you're going to find the present value. The other 20% at the end of each year, the company is going to be, okay, we incurred $10,000 because of production this year. Let's add it to our arrow. So that's how you're going to recognize it. And hopefully, if their estimations are good, at the end of the 10 years, they're going to have a balance in their arrow of $650,000. We're going to find the present value of the $520,000. The rate that we're going to use is the discount rate that they have given us, so 7%. Number of period is 10 years. There's no payment amount, and the future value is the $520,000. And it is at the end of the period. That means that you have an arrow of $264,000. Every end of the year, you're going to take an interest expense out of this amount here. These journal entries are the same, whether it's IFRS or ASPE. They don't change. B, record any entries related to this asset and obligation on December 31st, 2021 under IFRS and ASPE. Barrel Industries estimates that the increase in the arrow in 2021 due to the production of oil in 2021 was $20,000. I'm going to start with IFRS. So because you have an asset, a long-term asset, you're going to have to take the depreciation expense for the year. So we're going to first start with the depreciation expense for the oil platform. So use straight line amortization. So they're just going to take the book value divided by 10 years. The book value is not just your 2.5 million. You have to be careful. It also includes the 264,000 that you got here. So I'm going to add the two together and divide it by 10 years. After that, you're gonna want to record your amortization for the arrow for the year. So you want to do your interest expense for the year, and that's gonna add to the arrow book balance at December 31st. The interest expense is calculated by doing your market rate of 7% times your book value of the arrow, so 264,000. Next year, December 31st, 2022, what you're going to do is you're going to add these two values together, and you're going to do times 7% to find your interest expense. So you always look at the book value of the previous period to calculate your interest expense. Yeah, Jonathan.
Don't we need to record also the 20% variable cost? Doesn't that affect the interest expense, or is it after?
No, it's going to be the year after. If you have any production costs in 2021, it's going to be added to your arrow balance for 2021. And then the year after, you're going to take your book value of the arrow, which is going to include the 20% if there was any during the previous year. And that's when you're going to use it to calculate your 7%. So you only you added this year and you only use it in your calculation of the interest expense the year after.
Oh, okay. So ongoing doesn't occur when you acquired it, and it's only next year.
Exactly.
Okay, thanks.
No problem. But speaking of that, we have actually the variable costs for the year. So it costs them $20,000 during the year to use the assets. So that $20,000 is going to be added to manufacturing overhead for IFRS, and it's going to add to your arrow, and you're going to put $20,000. You don't need to give this amount. So you just add the amount that they give you. You don't need to do like present value in 9 years. And then next year, when you're going to calculate your interest expense, you add all of these together, and you do times 7%. Under ASPE, ASPE, you're also going to have your depreciation expense. That doesn't change, and it's going to be the same amount. Here, your interest expense is going to be the same amount, but it's going to have a different name. Instead of interest expense, it's going to be accretion expense. And here, your manufacturing overhead, again, it's the same amount, but you're going to add it to your asset balance. So you have to be careful under ASPE because you're going to have to next year depreciate this amount too, but not over 10 years, over 9 years, because it wasn't there for 1 year. Any question on these journal entries? Yeah, Jonathan.
Something I'm not getting is like the 20K, is that the variable cost, the 20%, or like what's the difference between the 20% and the 20K that's mentioned here?
Yeah, I mean, yeah, it's confusing because they're the same amount, but yes, your $20,000 here is your variable cost. So the 20% here is like what they estimate over 10 years. They estimate that 20% is going to be of 650,000 is going to be cost because of in production. So it's going to be a variable cost, and each year they're going to incur production costs, and at the end, that sum is going to be 20% of 650,000. So each year they should give you an amount, or not, depending on what happens, but they should give you an amount of how much was incurred because of in production activities. So your variable cost. In 2021, that variable cost was 20,000. In 2022, it might be 5,000, and in 2023, you might not have anything. So it depends on the year and the level of production that there was during the year.
Okay, thanks.
No problem. Assume that at the end of the 10 years, Barrel Industries paid $900,000 yeah, 900,000 for the dismantling and removal of the old platform. Record this cost of dismantling and removing the old platform. So they thought that it would cost them 650,000, right? That was their estimation here. So after 10 years, after they take into account the interest expenses and the variable costs, it should give them a book balance in their arrow of 650,000. But it actually cost them 900,000. So it cost them more than they thought. So they're going to record a loss of the difference between their arrow book value and what they actually paid. So what you're going to want to do is remove from your book your asset retirement obligation, which the balance here should be 650,000. You're going to credit your cash for 900,000 because that's what they paid. So here is your estimation, what you actually paid. And then here, because it's loss, they paid more than what they thought, you're going to have a loss on, I think it's the commission, loss on the commission for the difference between the two. If they had paid less than what they estimated, then they would have a gain. And that loss is going to be in their statement of earnings at the year that it happened. So it's not going to go in OCI, it's going to go through P&L. Right. For D, using the same data as presented in the problem, assume that on January 1st, 2024, the expected cost to dismantle and remove the old platform will now be 1,250,000. No increase in the arrow due to production of oil was made after 2021. Prepare the journal entry needed to account for this change in estimate at January 1st, 2024 under IFRS. All right, so if you remember for the theory, we now have a change in the estimate. So we thought it was going to be 650,000, but it's actually going to be 1.25 million. You're going to want to find the present value of that 1.25 million at January 1st, 2024. Compare it to the book value of the arrow at January 1st, 2024. And then you're going to adjust for the difference between the two in your asset and in your arrow balance. So first, we're going to find the book value of the arrow at January 1st, 2024. We know that the book value at the end of 2021 was 264 plus the increase because of the interest expense plus the increase because of the 20,000. So our book value was 302K. Then our book value for 2022, because they said that there was no increase because of production of oil, so there was no increase because of variable costs. All that you have to take into consideration is the interest expense. It's going to be your book value of 2021 times 7%. Well, 1.07 because you want to keep the balance of 2021 and you just want to add 7% to it. And then you want to do the same thing for the book value at December 31st, 2023. So you have a book value of 346K at January 1st, 2024 and December 31st, 2023. So here what I did 264K from the acquisition plus interest expense plus 20K from production in 2021. Here I did the book value of 2021 times 1.07 to add the interest expense. And I did the same thing here, but I took the book value of 2022 times 1.07 So we're going to compare the present value of the 1.25 million to the book value here of 346K. So here's present value of million. So our present value is going to be, the rate is still 7%. The number of period, so it's on 10 years, but 2021 has passed, 2022 has passed, and 2023 has passed. So the number of periods that are left is 7, because there's already 3 years that have passed. There's no pyramid, and the future value is 1.25 million. And it's end of period. So the only difference here is that your N is on 7 years instead of 10. So the difference between the two is $431,000. So you want to increase your asset and your arrow by this amount. Whoops. And that's basically it for asset retirement obligation. That's really like, they could ask you to do 2 years of journal entries, but you basically do the same thing as what you did here, but for the year after. They can't really do much more than that. So any question? All right, I'll give you guys a second just to write everything. Okay. So for question 3, payroll and benefits, I didn't talk about it in the theory because there's not much theory to it, because basically how you account for salaries is based on what the problem gives you. The book has really good problems for payroll and benefits. From memory, it's like problem 10 and 11. But it's really like the most complicated it's going to get. This is just me having fun and making it long and complicated just so you get the practice. But in the exam, it's most likely that those type of questions going to be in the multiple choice section. You're just going to have to say like the balance of the account is this, or the journal entry is this. Yeah, so here what we're looking for is the payable accounts. So salary payable, wage payable, vacation payable, and what's going to be the book value of that at the end of your financial year, and how you accrue for it, and also maybe what are going to be the journal entries when you actually have a payroll that goes through. So question 3. ABC Limited started operations on January 1st, 2020. The company employs 10 full-time employees. They're all paid $30 per hour for the year 2020 and $35 per hour for the year 2021. The standard workday is 8 hours. The employees get paid every 2 weeks on Fridays. They each pay $120 to their union every paycheck and have a deduction of $550 for income tax purposes. The CPP rate is 5.25% for the employees and ABC Limited. The EI rate is 1.58% for the employees and ABC Limited, pays 1.4 times this amount. As for the vacation days and sick days, each employee accumulates 15 fully paid vacation days per year and 5 fully paid sick days per year. ABC Limited has decided to accrue their vacation day benefits at the end of the year of when they are earned. The employees can take their vacation days the following year at their current hourly rate. As for the sick days, the company decided to only recognize sick days when they are used, and they do not accumulate if they are unused. In 2020, each employee took 0 vacation days and 2 sick days. In 2021, each employee took 10 vacation days and 1 sick day. So a lot of information. So the kind of risks with these kind of problems that you forget about like one line. Prepare the necessary journal entries to record the payroll made every 2 weeks in 2020 if the salaries and wage paid and the employer payroll taxes are recorded separately. So they're asking us to do the journal entries that they would pass every 2 weeks in their books when there's the payroll. So first, you want to account for the salary and wage expense and any payable that result from it. So you're going to have, now it depends on every company, but in your policy, you're going to have a salary and wage expense account where you're going to put the gross amount of the salaries of each employee. So that's the amount without any deduction for benefits. Here, they're telling you, I'm going to do a calculation first on the side so you can see it. So here they're telling us that they have 10 full-time employees. And they're paid $30 per hour. And their days are 8 hours a day. And if they're paid every 2 weeks, there's 10 working days in that 2 weeks, because we're not taking into account the weekend days. So Monday through Friday is 5 days, and then another Monday through Friday is another 5 days. So that's 10 days to the payroll. That would give us an amount of 10 times 3 times 8 times 10 of $24,000. So that's the gross wage for the 2 weeks period. Then we go back in the problem and we look at, okay, what are all the deductions that they take from their payroll? They say that they each pay $120 to their union every paycheck. So they're going to have union due payable. And that's going to be 120 times 10 employees. They have a deduction of $550 for income tax purposes. Then the CPP rate is 5.25% for the employees and ABC Limited. So here, all we're doing here is the employee portion. Okay, we're gonna do the employer portion of what they owe in a separate journal entry because they account for it separately. So here, the CPP payable is 5.25%, but it don't say of what. When you check your paycheck and all your deductions, they're based on your gross salary. So it's going to be 5.25% of the 24,000. I think I missed one. No, I didn't. The ER rate is 1.58% for the employees. So here again, the 1.58% is going to be based on the gross wages of the employees. And then, is there any other deduction for the employees? No, correct me if I'm missing something, but that's it for their deduction for the payroll. So the rest is going to be paid directly. It's going to be like their net wages. So what's going to go into their bank account? So it's going to be the 24,000 minus the sum of the other credits. So you just plug it, and it's 15,000. For the employer portion, they're going to record, so the employer portion is the benefits that the employer pays for the employees. So basically here, the employer is not going to pay any income taxes on behalf of the employee, but they're required by law to pay a portion of CPP and a portion of EY. Also, they might have a, how is it called? Like insurance. They may pay a portion of insurance for the employee. They also may pay a portion of pension fund for the employee. So depending on what the problem says, if the employer pays a portion for the employee, then that's going to go in your employer journal entry. And the expense account is payroll tax expense. Again, depends on the company, but normally in your problems on the exam, they all put it under the same expense account. And this problem, the employer only paid CPP and EI, and CPP amount that they needed to pay was the same as the employees. So we're just gonna use the same amount. And the EI amount was 1.4 times this amount, so 1.4 times the 1.58% that the employees paid. So you're going to do 1.54 times the EI payable that the employee paid, and that's going to be 531. And then you find your debit amount, which is just going to be a plug of your credit. Any question? All right, so we have done requirement A. So we have recorded the employee journal entry and the employer journal entry. For requirement 2, prepare the necessary journal entries to record the payment to the Receiver General for Canada and the Employees Union. So basically, here we all put them as payable. Now we've actually paid them. So we want to remove for payable accounts. So first, we're going to pay the union due, which is going to be in a separate payment because separate transaction from the rest, because they're not paid to the same person. They're paid to the Employees Union, and the other ones are all paid to the Receiver General for Canada, so basically the government. The union due payable was of $1,200. And then after that, you're going to be paying all the other ones, all of these. So your employee income tax deduction, your CPP payable, it's your employee plus your employer portion. You're going to add the 1260 plus the 1260. And the EY payable is also the employee and employer portion. And it's going to be 379 plus 531. And then your cash amount is just going to be the sum of all of your debit. So all your payable are now to zero, so you don't have any payable anymore in your balance sheet. Any question on the journal entries for payroll? All right, so let's go to requirement C. Prepare the necessary journal entries to record the transactions related to vacation entitlement during 2020 and 2021. Disregard CPP and EY during the calculation. So we're going to just go and reread it because I don't remember what they said about vacations. So they said that each employee accumulates 15 fully paid vacation days per year and 5 fully paid sick days per year. ABC Limited has decided to accrue the vacation days benefit at the end of the year of when they are earned. Okay, so we already have our information related to the expense amount that we're going to put in our statements, but then we also have to take into account when the employees actually take their vacation days. Sorry. The employees can take their vacation days the following year at their current hourly rate. So whatever they have accumulated during 2020 is going to be, they can take it in 2021, and what they have accumulated in 2021 can be taken in 2022, and they can take it. So whatever they accumulate in 2020 is going to be at their wage for 2020, but in 2021, if they had increased their salary or their wage, then they can take it at their new wage in 2021. As for the sick days, the company decided to only recognize sick days when they are used. We'll go back to that later. In 2020, each employee took 0 vacation days, and in 2021, each employee took 10 vacation days. So first, what I'm going to want to record is my expenses for 2020. And then I want to record if they took any vacation days during 2020. And then I'm going to record my expense for 2021 and record if they took any vacation days during 2021. So for 2020, the account can just be vacation expense. It could also go in your, it really depends on the company. Some companies want to separate it, and some company are just going to put it in their salaries and wage expense. It's up to them. And the problem, just look, it's going to be probably a multiple choice question. So just look at the type of accounts that are given. I prefer, well, that's just personal preference. I always prefer to separate it just to see, it's easier to like see quickly how much vacation you had for the year, but it's up to the management of the company and how they want to present their statements. Vacation expense, and then you're going to have a vacation payable. The vacation expense, so it's how many days that each employees have accumulated for the year 2020. So there was 10 employees, if you remember, and they all have 15 fully paid vacation days per year. So they accumulate 15 days of 8-hour days at their current wage, which is $30 per hour. Put it here. They didn't take any vacation days in 2020, so I don't need to record here a decrease in my vacation payable because they didn't use anything. So that's my only entry that I have for 2020. For 2021, I'm gonna record the same thing as here, so my vacation expense and my vacation payable. And here I'm going to do the same calculation, but I think there's a change. Yeah, there's a change in their hourly in their like wage for the year. So it's going to be 10 employees times 15 days times 8-hour days times $35 per hour. And then it says that each employee took 10 vacation days during 2021. So I'm gonna want to record that. Also, because there was a change in rate, you're gonna want to account for the $5 difference that's gonna happen. So how we're gonna do that, you're gonna increase your vacation expense for the difference of 10 days times 8 hours times $35 per hour minus $30 per hour. So basically your 10 days that the employees took, they took it at $5 per hour more than what we had accrued in 2020. So you want to recognize that in your expenses for 2021. Times 10 employees. Then your vacation payable. So here it's a decrease of what we had recorded in 2020. In 2020, we recorded everything at $30 per hour. So that's what we're going to use to calculate our decrease in vacation payable. So it's going to be 10 employees times 10 days times 8 hours times $30 per hour. And cash is what you actually paid them. So here it's going to be at $35 per hour. So we do the same calculation, 10 employees times 10 days times 8 hours per day times $35 per hour. So 28,000. And that would be it for the vacation journal entries. For requirement 4, prepare the necessary journal entries to record the transaction related to sick days during 2021. For sick days, they said that they only recognize sick days when they are used. So that means that when an employee takes a sick days, that's when they're going to put their journal entries for that. So in 2020, each employee took 2 sick days. So in 2020, you can just put in salaries and wage expense, or you can have a separate account for that. So what you paid for sick days in 2020 was 2 days times 10 employees times 8 hours per day times $30 per hour. Whoops. And then in 2021, each employee used 1 sick day. So I'm gonna copy this here and also copy this, and then just change my formula for 1 day instead of 2. And also change the hourly rate to $35 per hour. Any questions on just payroll in general? I know this is a long problem and it's probably more complicated than what you're going to get on your exam, but it's a good like overview of everything. Yeah, Jonathan.
Don't we accrue 5 days of fully paid sick? Instead...
Yes. So each employee have the right to 5 fully sick days, but the company decides to only recognize sick days when they are used. So that means that they're only going to recognize in their book the sick days when the employee actually takes a sick day. So the difference with vacations is that here the company has decided to accrue the vacation day benefits at the end of the year of when they are earned. So it's just that ABC has decided to recognize the full 15 days because the employees are entitled to it and legally it makes sense. So they're going to want to have the payable for the 15 days at the end of the year. The sick days, the employees have the right to use the 5 sick days. So if they use the 5 sick days, then each time that an employee takes a sick day, they will recognize it. But they're not going to put a payable in their financial statements because for them, it's like they might not use the 5 days. So they might not have the obligation to pay the 5 sick days.
Okay, thanks.
It's because it's more likely that the employees are going to take their full 15 days of vacation. So it's more likely that they're going to have to pay the full 15 days of vacation than the employees taking their sick days. So that's why they don't necessarily have to record the sick day payable. Again, it depends on what your problem says. Again, like if you work as a bookkeeper, it depends on what the company policy says. So there's not really a standard for payroll and benefits. It's just like recognize what you think you're gonna have to pay at the end of the year. For warranties, so remember there's two types of warranties. There's the expense, which the warranty is sold with the inventory, so you cannot buy it separately. And there's the revenue, which the warranty is sold separately. Did I say for? I don't remember how to spell that, but apart from the item that you buy. So question 4, Zellers Inc. sells laptop with a 2-year warranty against defect. They sold 300 laptops on account during 2021 for $1,500 each. Their laptops had a cost of $750 per unit. Zellers estimated a total cost of $75,000 for servicing the warranties for 2 years. During 2021, they spent $45,000 servicing the 2-year warranty that are included in each sale of their laptop. All transactions are paid in cash. Prepare the 2021 entries for Zellers Inc. using the expense-based approach for warranties. So, expense-based, so it is sold apart, like with the laptops. So what you're going to recognize first is your sale transaction. So your sales revenue and your costs. So they sold 300 laptops at $1,500. So they had a sale revenue of $450,000. And their costs and inventory are $300 times $750 per unit. And under the expense base, you want to record also your estimation of the cost that it's going to cost you to fulfill the warranties for 2 years for the 300 laptop. So you're going to recognize your warranty expense of your estimation. So here, estimated a total of $75,000. So that's what I'm going to put as my warranty expense. And I'm going to have a liability warranty, the same amount. So here it's really important that you do the estimation of the warranty cost. That's in 2021. Did I put for 2022? Oh, sorry. During 2021, they spent $45,000 servicing the 2-year warranties that are included in each sale of their laptop. So that's the actual cost. So the actual cost is going to come and reduce your liability warranty by the actual cost of $45,000. And let's say that they paid it cash. So this, your reduction in your liability is the actual cost of fulfilling their warranty. So this one is a little bit simple, I think, than the revenue, because you book your expense as an estimation, and then you book your liability at the same amount. And then when you actually have the actual cost of the warranty, then you reduce your liability. Requirement 2 is the revenue base. So prepare the 2021 entries for Zellers Inc., assuming that the warranties are not an integral part of the sale, but rather a separate service that is considered to be bundled with the selling price. Assume that of the total sales, $90,000 is identified as related specifically to sales of warranty contracts. Zellers Inc. estimates the total cost of servicing the warranties will be $75,000. Use the service type revenue-based approach. Warranty revenues are recognized based on the proportion of costs incurred out of the total estimation cost. So a lot of words. First thing first, still the same thing as earlier, you're going to record your sales and COGS transaction. So cash, same amount, 450,000. Then you're gonna have your sales revenue, and you're also gonna have your unearned revenue, and that's for the warranty. So that's the estimation of how much of the total revenue was because of the warranty that they bought separately. Here they give us straight up like the amount, which is 90,000. They could also give you like a specific percentage, like they think that 30% of the sales was due to the warranty. So then you have to calculate 30% of the 450,000. But here they give you the amount straight ahead. Sorry, warranty portion of the revenue. So here you're gonna plug it. So you're gonna do your 450,000 minus the 90,000. And then you have the same transaction for your COGS. Then your warranty expense is going to be the actual cost of warranty for the year. So that's the difference with the expense base. Expense was the estimation. Revenue base is the actual cost. The actual cost of the warranty for 2021 was the same as earlier, so it's 45,000. So your warranty expense is 45,000. And here, let's see that they pay cash for that, so 45,000. Now, because we actually incurred some warranty expense, you're gonna want to come and recognize a portion of warranty revenue. So you wanna reduce your unearned revenue to recognize the revenue that happened because of the use of a warranty by the customer. So you're gonna decrease your unearned revenue and you're gonna increase your warranty revenue. And here they said that the warranty revenues are recognized based on the proportion of costs incurred out of the total estimated cost. So that means that your 45. Oh, the total unearned revenue is 90,000. You actually incurred 45,000, and your estimation was 75,000. So these three numbers are going to be used in your calculation. What you want to do is find the proportion of your actual costs on your estimated cost. So you want to do 45,000 divided by 75,000. That gives you like a percentage. And then that percentage is going to be times your unearned revenue of 90,000. So that gives you a warranty revenue of 54,000. So let me just write it down here. So you do your 45K, your actual cost divided by your estimated cost times your unearned revenue of 90,000. So they estimate that in the future, they're going to have another 30K of warranty, and that's when you're going to have the final balance to get to 90K in your warranty revenue and your income statement. Any questions on the difference between the two? Yeah.
So next year, the remaining percentage will be recognized, like?
It depends, because next year they might have only 20K of actual warranty expense. It depends on what the problem gives you.
Okay.
For premiums, so if you remember, premiums are accounted for under the expense method, so it's another practice. But it's more like setting up, like kind of figuring out all the journal entries that come in and out, because you have to account for the premium. In this case, you have to account for mugs, you have to account for your liabilities, your expense. So there's a lot of little things that can come in the way. So I always set up, when I do premium problems, like a little table where I put the premium inventory, and that's going to be the number of units that they have in stock. I put the expected redemption in units and in dollars. So that's their estimation. So that's going to be their premium expense, and the actual redemption in units and in dollars. And then as I read the problem, I'm going to come and plug all my numbers here. It's just going to make it a little bit easier when you're doing the journal entries. You can also put the liability balance at the end of each year, because they don't ask it in this problem, but they could ask you like, what's the balance of the liability for premiums at December 31st, 2023? And you're like, oh, I have to calculate all of that. So I'll like that table, just make it a little bit simpler to calculate everything that's needed. So question 5, at the beginning of 2021, ADC Limited started a sales program for its coffee. Its customers had a reward card, and each time they bought a coffee, a stamp was applied to their card. After 10 coffees, the customers could buy a mug for $2. ABC Limited estimates that 65% of the cards circulating would be redeemed. During 2021, 13,750,000 coffees were sold, 700 mugs were purchased, 800 cards were redeemed. During 2022, 15 million coffees were sold, 920 mugs were sold, and 875,000 cards were redeemed. ABC Limited had 350 mugs in inventory on December 31st, 2020 at the same cost. Sorry, I had no more air. So to fill out my little table here, I'm first going to put the premium inventory at 2020 in units. So they told us that at the end of 2020, they had 350 mugs in inventory. I wish like it was a default like that in Excel. I'm sure I can put it as a default, but anyways. Then in 2021, what happened? So in 2021, they said that 700 mugs were purchased. So they added in their inventory 700 mugs. And they said that 800 cards were redeemed. So that means that when the cards are redeemed, the customer can buy a mug. So if there's 800 cards that were redeemed, that means that there was 800 mugs that were purchased by the customers. So that's a reduction in the inventory by 800,000. So at the end of 2021, they had an inventory of 150 mugs. Okay. The expected redemption for 2021. So how many mugs did they expect to redeem? It's going to be based here on the info in the problem. So they estimated that 65% of the cards circulated would be redeemed. To find the number of cards that were circulating, you have to find the number of coffees that were sold. There was 13,750,000 coffees that were sold. And you have your card is completed after you bought 10 coffees. So that means that there was 13,750,000 divided by 10. So there was 1,375,000 cards in circulation during 2021. And they estimate that 65% of the cards would be redeemed. So we're going to take 65% of the amount that we calculated. That gives us an expected redemption of 893 mugs for the year. Are we still following my little calculation here? I think so. Okay. In dollars, what that means is basically we're just taking the number of units times the cost of the mug. Oh, times like the sales price of the mugs. So it's times $2. So we think that we're going to receive 1.7 million as a result in revenue as a result of this premium policy. The actual redemption for the year, there was actually 800 cards that were redeemed. So there was actually 800 mugs that were purchased by the clients. So just be careful here, because here they're purchased by the company and here they're purchased by the clients. So the actual amount of unit was 800,000 at $2. So that gives us a revenue of 1.6 million. My liability amount. So I'm going to do the journal entries at the same time so you can visualize it. 2021, at the beginning of the year, I was expecting to have a redemption of 1.7 million, but my actual redemption was 1.6. So how I would have set it up at the beginning of the year, I would have thought, okay, my warranty expense and premium expense, right? And my estimated liability for premium is going to be 1.7 million. At the end of the year, they're going to say, okay, no, it was actually 1.6. So I have to reduce my estimated liability by the actual redemption of 1.6. And then let's see that it was the inventory, premium inventory of 1.6. So my liability went from being 1.7 minus 1.6. At the end of the year, my liability for premium is going to be $187,000. You also need to account at the beginning of the year for your premium inventory that you purchased. It's just like how they get you because you forget to do it, like I just did. Your premium inventory is basically the purchases for the year. So they purchased 700 mugs at $2. That's for 2021. We're going to come and do the same thing for 2022. In 2022, there was 15 million coffees that were sold, 920 mugs were sold, and 875 cards were redeemed. So again, here it's supposed to be purchased. Sorry, I'm the one that wrote them, so maybe I got mixed up in my words, but here is the 920,000 mugs that the company bought. So that's going to be an increase in my premium inventory. And 875 cards were redeemed. So the customer purchased 875 cards. So that's a decrease in their inventory by 875,000 mugs. So my ending inventory for the year was 295,000 for the mugs. Now my expected redemption, we're going to have to find the number of cards that were circulating during 2022. The number of cards, again, is going to be the number of coffees sold divided by 10, because that's when a customer gets a full card. And then we do the 1.5 million times 75%, because the company estimates that 65% of the cards will be redeemed. So that gives us in dollar an estimation of 975 units times $2 of 1,950,000. So in 2022, my first journal entry is the same as earlier. It's going to be the purchase of my mugs. So it's going to be 920 times 2. Then I'm going to set up my premium expense. Premium expense is going to be my expected redemption, and that's going to be the amount that you found here, the 1,950,000. And then for my actual redemption, It was actually 875 mugs that were redeemed at $2. So my actual redemption is going to come and reduce my estimated liability to by 1,750,000. I'll put cash here. No, I'm going to put inventory premium. So I set up my expense as the estimation. Then I put the liability for the same amount, and then I reduce my liability by the actual cost for the premium. My liability would then balance at the end of 2022 would be the beginning balance of the year plus my expected minus my actual. And that's all the journal entries for question 5. Any questions? Yeah, Jonathan.
So this is like the expense method, right? It's like, is there 2 ways for premiums or?
Normally for premiums, they account for them using the expense method. And from what I remember in your exams, they always use the expense method, but they could also decide to use the revenue-based method. And in that case, they would give you the information to be able to do the revenue-based. And it's the same logic as for warranties. So when you're going to be doing your coffee revenue, sales revenue, you're going to account for unearned revenue for your premium. And then you're going to have your premium expense is going to be the actual cost of the mugs. And you're going to recognize your warranty, your premium revenue every time a mug is sold.
And you still use the percentages as
it's going to be depending on what they give you in the problem. Okay. So yeah, it depends on the problem information. Thanks. But like I said, most of the time it's using the expense-based approach for premiums. I have one last problem for chapter 13, and then we'll take like a 10-minute break and jump in chapter 14, if that sounds good. So just hold on to it a little bit longer. So for contingencies, this is type of question that you'll get in a multiple choice question. Like, be ready, you're gonna have multiple choice questions about contingencies for sure. So a customer of ABC Limited filed a lawsuit against ABC following an accident where the ceiling of the store fell on him and injured him. The attorneys of ABC Limited, after careful review of the evidence, were of the opinion that there's a probability of 80% that ABC will lose the case. The attorneys presented their assessments of possible outcomes along with estimated probabilities. However, they refused to give a precise estimate as no amount is that more likely to occur. And then they're asking us to determine the amount of liability, if any, to be reported under ASPE and IFRS, and the journal entry that goes with it. So if we start with ASPE, there was 2 criteria that needed to be fulfilled for it to record to do a journal entry for the contingent liability. First, is it likely for more than 70% that the situation is going to occur? And can the loss be reasonably estimated? So here, is it likely that they're going to lose the lawsuit? If you go back in the problem, is there a certain like percentage that they're giving us to tell us that they might lose a lawsuit? Yeah. So they gave us 80% as a probability that the lawyers put. So since 80% is more than 70%, then yes, it is likely. And can the loss be I don't know how I spell that, reasonably estimated? Again, yes, because they're giving us a range. So with that range, we can estimate it. However, they give us the range, but they don't give us like a more likely estimate. So they're not giving us a defined like estimate. So because of that, what we're going to record in our book is the lower of that range. So we're going to disclose in our book a contingent loss of 500,000. And then contingent liability. They're going to have to disclose, because it's ASPE, they're going to have to disclose in their books that they could have 220 more of a loss if it occurs. So like disclose under ASPE in your book, your journal entry is the lower amount of the range. So you're not doing a weighted average for all of it. Under IFRS, so under our IFRS, it's probable, so more than 50%. So that's yes, we already went over it. And it's same thing. Well, it's not gonna be a loss here, it's gonna be like obligation. And again, it's yes. And under IFRS, you're going to calculate the weighted average of all of this together to find the amount that you're going to report in your statements. So here it's going to be a contingency expense, so not a loss, contingency expense, and a provision. It's not contingent liability, it's provision for contingency. And the amount is going to be 500,000 times 11% plus 560,000 times 15% plus 610 times 20% plus 650 times 25% plus 190 times 60% plus 720 times 13%. I think my numbers are good. If you get a different number, just let me know. I might have. So under IFRS, that's what you would report in your statements. Any questions for contingency? All right, let's take a break until 11. And then we'll do chapter 14 and 16 afterwards. And I think it depends how, I think we'll finish like around 12:31. All right, so have a good break. All right. So I think it's going to be another 2 hours, depending on the questions. Chapter 14 is about long-term financial liabilities, but more specifically, all about loans, bonds payable. You have different types of long-term liabilities. Mortgages also fall into what we're going to see in chapter 14. They're all accounted for the same way, but there's also pension and lease. That's going to be in a later chapter. That's going to be for your final exam. So we're really concentrating on like interest expense, market rate, coupon rate, book value, face value, market, all that stuff. And basically, long-term liabilities are obligations that are payable in more than a year. So you have current liabilities, and then your long-term liabilities is where anything that's older than a year goes. So bonds are mainly what your problems are going to be about during your exam. So for bonds, they're the most common type of long-term debt. And a company will issue bonds when they need a large amount of money that is too big to be provided by only one issuer. So maybe you're asking 15 million from your bank, but your bank doesn't want to give you 15 million. So instead, you're going to issue your bonds and get 50 million in cash, and then you're gonna give interest and repay the bonds over time. For bonds, there's also like a bond indenture, which is basically the contract, and it states like everything related to the bond. So the stated interest, the coupon rate, when they come due, the period interest amount that's going to be given each period. When for long-term debts, there's three types. Three ways that you can recognize them. But chapter 14, you recognize them using the amortization method. So that means that you're going to find the present value of your bonds, and that's what you're going to put in your books when you issue it. You're also going to adjust your book value for any directly attributable issue cost, which is going to come and reduce the carrying value, and that's only when you issue your bond. If you have any admin costs afterwards, they're going to go in your expenses through your P&L. There's two methods to account for amortization. So there's the effective interest method and the straight line method. Straight line method is only used under ASPE. We're going to see how it is, and effective interest method is used under IFRS and ASPE. So bonds can be sold at par, at a premium, or at a discount. At par, it means that your issue price, so the price that you put in your books now, is the same as your maturity value, which means that your coupon rate on your bonds is the same as the market rate. At a premium, it means that your issue price is more than your maturity value, so your coupon rate is going to be more than your market rate. And each period, you're going to amortize by the bond by reducing the carrying amount of the bond in your books. And issued at a discount is the reverse of a premium. So your issue price is lower than your maturity value. Each period, you're going to come in, increase the book value of your bond in your books. So I've put for each type an amortization table and how to calculate each column. So the cash column is what you're going to pay to the bond holders at each period. And that's calculated by using the coupon rate that's on the bonds and the maturity value. You time them together and you divide it by the number of payments per year. So let's say that you have 4 payments per year, you're going to do divided by 4. And that's the amount that you're going to pay each period. The interest expense is the interest expense. So it's take into account your future value of the debt. And that's calculated by taking your book value of the previous period due times your market rate and divided by the number of payments per year. So like we did the interest expense for the arrow earlier. And amortization is going to be the difference between the two. So the difference between the cash and the interest expense, and that's the amount that's going to come in and change your book value at the end of the year. So at par, because your cash and interest expense are going to be the same, because your issue and maturity value are the same, and your coupon rate and your market rate are the same, there's going to be no amortization. So you're not going to change your bonds payable value. So your journal entry is only going to be interest expense to cash. If you have issued it at a premium, normally your coupon rate is going to be higher than your interest expense. So that difference between the two is going to come and reduce your book value for the year, because your book value is going to be higher than your maturity value at the end. So you want to come in and reduce it to get to your maturity value. So taking the same transaction as earlier, you're just going to come and debit your bonds payable account to reduce it by the amount of the amortization. And for issued at the discount, reverse of at a premium. So your interest expense is going to be higher than your cash. The difference between the two is going to come and add to the book value of the previous period. So because your issue price is lower than your maturity value, so you want to increase it as each period to get at the end to your maturity value. And here are the journal entries that you're going to credit your bonds payable to make it higher. So that's the effective interest method. For the straight line method, a little bit easier. What you're going to do is you're going to find the difference between your maturity value and your issue price. So the difference between your issue price and your maturity value at the end. The difference is going to be divided by the number of periods in total that you have throughout the whole debt. So if it's over 20 years and you have 1 period per year, you're going to divide the difference by 20. And that's going to be your amortization amount each period. So it's not going to change. So here under effective interest method, it's going to change depending on a bunch of different factors. So your amortization amount is always going to be different. Here, it's always going to be the same thing. The journal entries are here. So it's basically it's the same journal entries as with the effective interest method. It's just that your amounts are going to change. When do you remove a debt from your books? There's two ways. It's either when you pay back the debt in full, or when the debt is either canceled or expired, so you don't have the obligation to pay it back anymore. When that happens, you're gonna remove the debt from your book, and if you pay anything, so if you have to pay to your final payment, for example, and you're going to find the difference between your payment price and your book value in your books, and that difference is going to be booked at a gain or a loss. You have to amortize your debt all the way up to the day that you remove it from your books, even if it's not like a payment period. Like I say, it comes in the middle of 2 payment period, then you're gonna amortize it all the way up to the day that you remove it from your books. So I've put an example here that you can look at it when you have the time. And then troubled debt restructuring. The difference between that and extinguishment of the debt is that is not part of like the ordinary flow of the debt. So this is more like, I'm the company, I don't have any cash anymore to pay back my debt. So the bank is like, okay, it's fine. We're gonna grant you like, we're gonna give you like either a new debt, or you don't have to pay back the full amount of the debt anymore. So the difference is that the bank is giving the right to the company to not follow the normal payment schedule. So the two situation is that the company is going to pay back the debt, but at less than what it owes. So let's say that the book value of the debt is like 2 million, but I only pay 500,000. That's going to be the first situation. And the second is that the bank is going to issue a debt. Well, no, sorry, they're not going to issue a new debt. They're going to change the terms of the debt. And then based if it's a big difference or a small difference compared to the old terms, then they're either going to treat it as a new debt or a modification of the terms of the debt. I'm saying debt a lot. First, for the settlement of the debt, so if they're paying an amount lower than the book value of the debt, they're going to remove from their books the old debt. They're going to book also their payment. And then the difference between the two is normally a gain because they're going to be paying less than what they actually owe. And the creditor on their side, they're going to do essentially the same thing. They're going to remove from their books their receivable. They're going to book what they receive. And for them, it's normally going to be a loss because they're receiving less than what they should have. What they can pay with can be cash, could be shares, could be a building. It could be cash from another debt that they use to pay back this debt. So it could be really anything. And if a building, for example, is used, you have to take into consideration the accumulated depreciation of that asset when you're taking it to pay back your debt. And then if shares are used, you're using the market value and you're comparing it to the book value of your debt, and then you're booking a gain or loss. For modification of the debt term, it could be literally anything. Could make the debt longer, could change the interest, could change the maturity value, could change the currency, could be a bunch of different things that happens to the debt. And you're gonna want to look if it's a substantial modification. So if it is a substantial modification from the old terms, so that means that it's a big change in comparison to the old terms. You're going to want to remove the old debt from your books and then book the new debt in your book and then record a gain or loss for the difference between the two. So how do we know if it's a big difference? It's if the present value of the new term, so the new terms, you find the present value using the old interest rate, so using the old K, is at least 10% different from the present value of the old debt. So you always want to calculate the present value of the new terms using the old interest rate. That's what they're going to test you on during the exam. It could also be that there's a change in creditor and the original debt is legally discharged, but maybe in practice it's more common, but for your exam they're always going to test you on point 1. And then if one of those conditions met, the transaction is considered a settlement. So that means you're removing the old debt from your books and you're putting the new terms in your books. So you're just like debiting bonds payable old, you put the book value, crediting bonds payable new, you put the present value using the new interest rate. So you're going to have to do 2 present value calculation, and then you book a gain or loss for the difference between the two. And then the bank is going to do the same thing in their books, but for them, they don't care about the new interest rate. They're always going to be using the old market rate. When it's not a big change, it's called a modification. So the old debt is seen to be it's still the same debt. So there's no like old or new, it's still the same one, but with changes to its term. So under ASPE, what you're going to do is you're going to do a new amortization table where you're going to put your present value as the old debt and your future value as present value as the old term and future value as the new terms. And basically each period you're going to amortize by the amount that you get to get at the end of the term to the future value of which is going to be the value of the new terms. So when you're doing your calculation, you can put these values and basically you're going to try and find your new interest rate to discount after your book value to the new maturity value. And then if you want to see an example in your book, you can see example 14.18. They do an amortization table. And for IFRS, you're going to recognize immediately the difference between the two. So you're going to record a gain or loss for the difference between the book value of the old terms and the present value of the new terms. And then you're going to do an amortization table as normal with the new terms. So the difference between IFRS and ASPE is that under IFRS, the gain or the loss is recognized immediately into your P&L, whereas under ASPE, it's recognized like over the new terms of the debt. So it's gradual. Any questions for the theory? Yeah, Jonathan.
So then under ASPE, the new interest rate is the market rate, or is it
Under ASPE, you're gonna basically be calculating the interest rate that you're gonna be using for your amortization table.
Oh, okay. Okay. Thanks.
Okay. Well, so for the first problem, they like to put an amortization table with blanks and then ask you like a bunch of questions on what is the cash amount paid. So you understand how to calculate each thing. So that could be one of the long questions. They could also already give you the whole amortization table and then ask you question based on the amortization table. So just be really comfortable with the table here. Question 7. You just started working at ABC and you are excited to learn all about bonds. While talking with your manager, she hands you a partially completed amortization schedule. She tells you that your first assignment is to answer the questions below and that it needs to be completed today. The information she gives you is that the bonds become due and settle on January 1st, 2025, and that the year end is December 31st. So then we have the table with a bunch of blanks. We don't know what the issue price is. We don't know what the maturity value is. We don't know what the cash is. We have some interest expense, some amortization, and some book values. So first, they're asking us what is the cash amount paid at every interest payment period. So they're asking us what is the amount that we put here. I'm just going to copy the table in my Excel. Is it exactly the same? Yeah, okay. So how would you go about finding what's the amount that we put here? Is there a way we can get it with the values that we have in the table? Yeah, Jonathan?
I think you can find like the cash by like it's either because for October 1st and January 1st, 2023 and 2022, you can see whether the cash payment is the same either by adding or subtracting from the interest.
Yeah, so you're right. So because we have the amortization here and we also have the interest expense here, the other part of the equation is the cash amount. So we can use these two values to find the cash. Now, the question is, like you brought up, is do we add them together or do we subtract them? And that's going to be based on whether the bonds are issued at a premium and or at a discount. So if we remember, they're issued at a premium when the coupon rate is greater than your interest. And when your issue price, I'm going to put it as present value, is greater than your future value. That means here you have a bigger amount than here. So each period you're going to reduce it. But here we see that it is increasing. So it's already like, oh, I don't think that's what it's going to be. If it is at a discount, your coupon rate is lower than your K and your present value is lower than your future value. So that would be the case here because your book value here is getting from lower to higher. It's increasing each period. Because of that, we know that our interest expense is higher than our cash. If you remember like the little table, I can show you, I guess. Yeah. So here, this is going to be higher than this. So what I'm going to do to find my cash amount, well, the amortization then is going to be the interest expense minus the cash. So to find my cash amount, I'm going to come and reduce my interest expense by my amortization amount. Everyone is following how I got there? So for example, if I take the values at January 1st, 2023, to find my cash, I'm going to do my interest expense minus my amortization. So it would be 7280 minus 9,580. That gives me a cash amount of 62,500. I can come and verify it with the October 1st, 2022, just to like double check. So it would be 71,801 minus 9,301. It's the same amount. So that's good. You can also come and check it with January 1st. You can also come and check it with July 1st, but it should always give you 62,500. So that's the amount of cash I'm going to be paying at each reporting that date. I don't remember if it goes at the end. Yeah, it does. Okay, so we got the first one. Now they're asking us, what is the annual market rate? So how would we go about in finding it? It's a little bit more complicated because the market rate is used to find the interest expense, right? Let me just check something. Yeah, Jonathan?
Is it just like dividing the carrying balance of last year's by the interest payment of like the year you chose?
Yeah, it's exactly that. Hold on, I'm getting my terms mixed up. Right, so that would be the coupon rate, what you said. So you do the 60, I think that's what you meant. You take the 62,000 and you use your maturity value to find your coupon rate. But here we're trying to find the interest rate. So the rate that's used to calculate your interest expense here. So normally when you calculate your interest expense, you do the previous book value times your interest rate and divided by the number of periods. So we're going to try and find a line in our table that has the interest expense and the previous book value. And we know that the number of periods is 4. So if I take October 1st as an example, we got the 7,801 by doing 2,393,372 times our K that we're missing, that's what we're finding, divided by 4. So if I isolate my K, it gives me 7 times 4 divided by 2,393,372. It gives me a market rate of 12%. So does anyone have any question on how I got there? No, you can't really come and verify because you don't have any other line in your table where you have all the information required. So just trust yourself when you're doing it in the exam. The third one is going to be, what is the maturity value of the bond? So what is the value here? Yeah, Jonathan.
Sorry again, but like the 4 is like the period of like at October 2022.
Here.
Yeah, where did you get the 4?
Yeah, so the 4 is the number of periods that you have per year. So here, in 1 year, I have 4 payment dates. I have January 1st, April 1st, July 1st, and October 1st. So that gives me the 4.
Oh, okay, okay.
sorry, I went a little bit fast, but if it was only June 30th and December 31st, for example, then it would be 2. So you have to look at your date here to find your number of periods. So to find the maturity value, you have to find here what is going to be my value. And to do that, there's no other ways than calculating what is my book value on the previous period and then filling up my last row of values here. So if I remember, I already found my cash amount here. So actually, I don't even need it because I already have my amortization amount here. So what I'm going to do is I'm going to add my amortization to my book value. And then I'm going to calculate my interest expense for January 1st, 2025. So to calculate it, I do my previous book value times the interest that we just found of 12% divided by 4 periods. And then I find my amortization by subtracting my interest expense by my cash amount. And I add the amortization amount to my book value. That gives me a maturity amount of 2.5 million. So what I did, found my book value of the previous period, found my interest expense for January 1st, 2025, calculated the amortization, and then I found my book value of 2.5 million. You can also kind of deduct it by like where you're going, but if you have time in the exam, please like do it properly. And then they're going to ask us what is the coupon rate. So the coupon rate is used when you're calculating your cash amount. So how you find this is by doing your coupon rate times your maturity value divided by the number of period. So we're going to do the same thing here. We're going to isolate our coupon rate. So that means that the 62,500 was calculated by doing 2.5 million times my coupon rate divided by 4. If we isolate here, that gives me a coupon rate of 10%. Does anyone want me to go over how I calculated it? So what is the issue price of the bond? So we're trying to find what is here on January 1st, 2020, what is the book value? So to do it, we're going to find the present value of our future value. So we're going to try and find our present value here. Our future value is a 2.5 million. Our interest rate is what we found earlier. So it is the 12%. But it is the 12% divided by the number of periods, so divided by 4. So it's 3%. The payment at each period is 62,500. And then my number of period is over 5 years. And there's 4 periods per year. So 4 times 5 is 20. So you can use your financial calculator. There's also going to be the tables provided at the exam that you can use. But I'm just going to use Excel to calculate it. So my rate is the 3%. Number of period is 20. My payment is 62,500. Future value is the 2.5 million. And the type is at the end of the period. Yeah. So that gives me an issue price of 2,314,000. So on January 1st, 2020, they put their bonds payable at this amount. Then we're going to jump into the journal entries. So do you guys have any question on how you get each values? Okay. So for the journal entries, they're asking us to record the bond-related transactions on April 1st, 2020, December 31st, 2022, December 31st, 2024, and January 1st, 2025. So first, on April 1st, 2020, if we look here, April 1st, 2020, we only have in our table that's provided this 6,921, but we know that our cash was 62,500, and so we can determine what the interest expense is from there. So my interest expense is going to be the 62,500, my cash, plus my amortization of 6,921. My cash is going to be the 62,500, and then I'm going to increase my bonds payable by the amortization amount of 6,921. For December 31st, 2022, I go look here. So I'm going to look at January 1st, 2023. The cash here, the cash column is payable on January 1st, not December 31st. So instead of putting cash, I'm going to put interest payable. And then on January 1st, I'm going to reverse the entry to recognize the cash that I actually paid. So I'm going to put interest expense, bonds payable, and interest payable. My interest expense is 72.80. I'm looking here. My bonds payable is going to be 9,580, and then my interest payable is the same amount as the cash for April 1st, so it's 62,500. On December 31st, 2024, it's going to be the same as here. But my interest expense, I think we calculated it here. My interest expense is going to be the 74,636. Bonds payable is going to be the 12,000 that is in your amortization column, and then the interest payable is going to be the 62,500. And then the last one is on January 1st, 2025. So what happens on January 1st, 2025 is your bond is like you're paying it all back, so it's done. So you want to remove the bond from your book. So your bond payable, the balance should now be your maturity value of 2.5 million. You're going to remove that from your book, and you're also going to remove from your book the interest payable that we had put in our books on December 31st, 2024. And you're going to pay to the bondholders the sum of the interest plus capital of the bond. Any questions? Okay. The seventh is the straight line method. So what would have happened if ABC used the straight line method instead of the effective interest method? And what would have been the journal entry on September 1st, 2020? So first, I'm going to try and find what is the book value of the bonds on November 1st, 2022. Because, wait, I'm not looking at the right thing. Sorry. I'm going to first find the difference between the issue price and the maturity value. So my issue price, we found that it was 2,314,000, and my maturity value is 2.5 million. So the difference between the two is 185,000. There's 20 periods, so that means that at each period, the amortization amount is 185 divided by 20. 9,292. We're looking for the journal entry on September 1st, 2020. It was supposed to be October 1st, if you want to correct that. Oh no, sorry, I'm not even looking at it. Yeah, no, sorry, it's supposed to be October 1st. I'm getting confused with the question after. So remove September and put October. So we're doing the journal entry for here. So under the effective interest method, we would have put the amortization as 7,342, but here we're going to put it as 9,298. So our interest expense is going to be applied. My cash amount is still the same, it's still the 62,500. And my increasing the bonds payable is going to be the 9,298. My interest expense is going to be, yeah, Jonathan?
How did you get at 9,298 again?
Yeah, so I found the difference between the issue price and the maturity value. That gave me 185,000. And I divided that amount by the total amount of period for the loan. So in this case, it's 20 periods. And that gives me at each period an amortization amount of 9,000.
Okay, thanks.
No problem. So here, just to make sure, it's October 1st, 2020. You can still find it for September 1st, 2020 by like doing 2/3 of this amount, and then 2/3 of this amount, and then 2/3 of this amount. But we're gonna do that in H, so I'm not gonna do it twice. But you can definitely find it for September 1st if you're filling up to the challenge. And finally, for 8, what would be the journal entry if ABC redeemed the bonds at 104 on November 1st, 2022? So that is the extinguishment of the debt. So what that means is that they paid the bonds early. So they paid it on November 1st, 2022 instead of January 1st, 2025. And they paid it probably at more than what was the actual value. Redemption of bond. So what you want to do first is calculate the book value of the bond on November 1st, 2022. Well, November 1st, 2022, it's like in between these two, right? So we have the book value on October 1st. We have the book value on January 1st. But it's like a month later than October 1st. So you want to amortize the bond for 1 more month. To do that, you're going to take the amortization amount from January 1st and multiply it by 1/3. So I'm going to do 1/3 times 9,580. And that's going to give me 3,193. And that's going to be added to my book value on October 1st, 2022. So the book value is of 2402674. My book value on November 1st is 2.4 million. Then I want to calculate how much they pay to redeem those bonds. It says that they redeem the bonds at 104. And when you have this type of number, it's 1.04 times the maturity value of the bond. So the cash amount that they paid is 2.5 million times 1.04. So they pay 4% more than the maturity value. They paid 2.6 million. So we're going to remove from our books the bonds payable, which the book value is 2.4. We're going to remove cash of 2.6 million because that's what they paid. And then we're going to record a loss on redemption because they pay more than the book value of bonds of the difference between the two. Any questions on this? I'll let you guys write everything. Okay. So the next problem is on modification of debt. So it's major or minor settlement. There's two situations, so we'll read them all out. Situation 1, on December 31st, 2021, Rainy Inc. owes LTD Bank a 1.5 million, 15 years, 9% note issued at par that is due now. All interest has been paid. LTD Bank agrees to extend the maturity date to December 31st, 2024, reduce the obligation to $900,000 and reduce the interest rate from 8%. The market rate is currently 7%. And then situation 2, on December 31st, 2021, Rainy Inc. owes LTD Bank a 1.5 million, 15 years, 9% note issued at par that is due now. All interest has been paid. LTD Bank agrees to extend the maturity to December 31st, 2023, reduce the obligation to 1.4 million, and reduce the interest rate from 8%. The market rate is currently 7%. So for both situations, we're going to have to state if it's a settlement or a modification of the old debt. And then we're going to do the journal entries for Rainy and the journal entries for LTD Bank. So first situation, we need to find if it is a settlement or a modification. And to do that, we need to find if the present value of the new term is at least 10% different than the present value of the old. We're going to find that first. The present value of the old debt, they give us the amount here, it's 1.5 million because we're at maturity, right? So the present value is the maturity value of 1.5 million. The PV of the new term, we know that the future value, so the maturity value of the amount of the debt is 900,000. For the number of periods, we said that the So there's 3 more periods. There's 3 more periods because we're December 31st, 2021 right now. And the new terms will become and due on December 31st, 2024. So that's 3 years. And there's no mention that the interest is going to be paid like twice a year or 4 times a year. They just say that it's December 31st, 2024. So that means that my N is 3 periods. My K, so my interest, since here we're trying to find if it's at least 10% difference, we're going to use the old K to value the new debt. The old K was 9%. It's 9% because 9% is the coupon rate, well, the interest, but it was issued at par, so the coupon rate is equal to the market rate. Well, there's no coupon rate because it's the loan, so the interest was just 9%. And payment. So the interest payment that they were making every year. Oh no, sorry. The interest payment that they will now be making every year is going to go down from 9% to 8%. So it's going to be 8% of the future value, 900,000. 72,000. So I did 8%. So my present value is $877,000. So I'm going to use this number and compare it to the 1.5 and see if there is more than 10% difference between the two. So how you want to calculate it, it's like it's new minus old divided by old. So you want to do 877,000 minus the 1.5 divided by the 1.5. And that gives me a difference. Did I do that right? Yeah, that gives me a difference of 42%, which is more than 10%. So it's a settlement or a major modification. There's like different term, but it's like you're issuing a new debt. So the journal entries for Rainy Inc. for station 1, you're going to want now to find the present value of the new terms using the new interest rate. So here, the only thing that's going to change is your K, where you're going to use the market rate of 7%. And that gives me a present value of 923,000. So that's what you're going to book in as your new bonds payable. So the journal entry you want to do is you want to remove your old bonds payable from your books. So you're going to debit your bonds payable by 1.5 million. And you're going to want to credit your bonds payable new by the amount that we found here, the new present value using the correct interest rate. And then the difference between the two is either going to be a gain or a loss. Normally, it's going to be a gain because normally the company is going to have to pay less for their bonds. Gain on restructure. So it's going to be 1.5 minus the 923. So it's going to be a gain of 576,000. That's for Rainy. So that's for the ones that have to pay back the debt. For the lender, so for the bank, they're not going to change the interest rate here. I don't know why. I don't remember why. But for them, they're always going to use the old interest rate to value the new debt. So my with them. Okay, well, thank you, because the bank don't care about the market rate. So that's why they're just gonna use the old market rate for the, yeah, I remember seeing that in my notes now that you're saying it. So the bank doesn't care about the change in market rate, so you're always gonna use the old one. So you're gonna remove from their book, well, you're gonna add to their book the new bond receivable, which is gonna be the present value that we found earlier, the 877,000. And you're gonna remove from their book the bond receivable old, which is the 1.5 million. And for them, it's gonna be a loss on restructure of the difference between the two. That's for the bank. So that's for situation 1. For situation 2, on December 31st, 2021, Rainy Inc. owes LTD Banks a 1.5 million, 15 years, 9% note, issued at par that is due now. All interest has been paid. LTD Bank agrees to extend the maturity dates to December 31st, 2023, so a year earlier than the other one, and reduce the obligation to 1.4 million. And then interest is reduced to 8%, market rate is 7%. So we're going to do the same thing here. We're going to want to try to find if it's a settlement or a modification of the old debts. So we have the same present value as earlier of the old debt, which is 1.5 million. The future value of the new terms is now 1.4 million. And my N is now reduced to 2 because it's going to be settled in 2 years instead of 3. We're still going to be using the 9%. And here it's going to be, instead of 900,000, it's going to be 1.4 million. So that gives me a present value of the new terms of 1.3 million. So we're going to find if there's a 10% difference between the two. So we're going to do new minus old divided by old. So that gives us a difference of 8%, which is less than 10%. So it's a modification. For Rainy, they're gonna, I don't remember. Okay, let's say that they are using okay. For Rainy, let's say that they're using ASPE because it's a little bit more complicated than if they were using IFRS because we have to do the new amortization table. So Rainy uses ASPE. So what they want to go and do is find their new interest rate that we're going to use to calculate the new amortization table. Because the amortization table is going to, for 2 years, it's going to take the difference between my new present value and my old present value. My present value in the book and my old present value, and they're going to amortize the difference over 2 years. So to find it, I'm going to do my future value as 1.4 million. And my present value is 1.5 million. So my present value is what I have currently in my books, right? It's what the old terms are. My future value is now with the new terms. So at the end of the 2 years, I want my bonds payable account to be at 1.4 million. The number of periods is going to be 2 because I have 2 years to do that. My payment amount is going to be the same as we found here. So it's going to be 8% of 1.4 million. And then I'm going to go and find my K. can I find it like this? Okay. Interest. What are my other? Yeah. Does anyone remember what the formula is on Excel? It's fine. Wait, thank you. My number here is going to be 2. My payment is going to be 112. My present value, I'm going to put as a negative. My future value is going to be 1.4. My type is end of the period. So that gives me a K of 4%, 4.2%. So then let's do my table. Cash, interest expense, amortization, book value. So on December 31st, 2021, they have a book value of 1.5 million. On December 31st, 2022, they're going to have to pay cash the 112,000. They're going to have an interest expense of 4.2% times the previous book value. And the difference between the two is going to come in reduce my book value of the previous period. And then on December 31st, 2023, same thing here. Same thing here. And same thing here. So I get to my book value of 1.4. So you're not going to have anything to do on December 31st, 2021. But on December 31st, 2022, what you're going to be doing is you're going to have your note payable. Oh, it's no, I've been saying bond, but it's note payable. That's going to be reduced by the amortization amount of 48,000. You're going to have your interest expense of 63,000, and you're going to have your cash amount of 112,000. That's for rainy if they use ASPE. If they were to use IFRS, we would do the same thing as what we did in the previous situation. They would just recognize the gain immediately in their books. For the bank, they do the same thing as what they did earlier. So they're gonna have the new note receivable, add the amount that we found here, the 1.375. They're gonna remove from their books the old notes receivable at 1.5 million. And they're gonna book a loss on restructure the difference between the two. Any questions for this or chapter 14 as a general? For chapter 16, yeah, Jonathan?
Can you go back a bit? I haven't finished writing everything.
Yes. Do you need explanation or just looking at the Excel?
Just look at the Excel.
Okay. So let me know when you're done.
And done, thanks.
Also, if you guys didn't have time for other questions, at the end I can go back to the question you need. For chapter 16, it's about complex financial instruments. So question that you can have on this chapter is about warrants, options, convertible bonds, put options, call options. I think that's it. So financial instruments, they are whatever creates an asset in the book of a company and a liability or equity instrument in the book of another party. So primary financial instruments, it's like the bonds that we've been seeing, right? It creates a receivable in the books of the bank, and it creates a liability in the books of the company. Derivative instruments, they are financial instruments, but for them, their value is from an underlying primary instrument. So their value is based on, for example, the value of a share. They're based on the value of a bond. They're based, so it's not the derivative, its value could change depending on what they base their value on. So if the share changes prices during the derivative contract, then the value of the derivative will also change. Pretty much. One thing about derivatives, they're going to transfer the risks of whatever primary instrument that they rely on without either of the party actually having the final instrument in their books. So what that means, if the derivative base is priced on a common share, for example, well, the derivative is going to carry the risk of the common share changing value without having the company that has the derivative in its book actually having the shares. So they have three characteristics. So their value changes in response to the underlying instrument. So in response to the share, for example, they require little or no initial investments. So it's probably cheaper to buy a derivative than to buy the common share. And they're settled at a future date. Examples are options, forwards, warrants. They're all derivatives. So how you're going to measure it is at fair value, and any gains or loss are booked through net income. And normally you have the values in the contract for the derivative. Options and warrants, they give the holder the contractual right to acquire or sell an underlying instrument at a specific price within a specific term. So, for example, option to purchase shares for a company at a fixed price on a specific date. The underlying is the share. The option derives its value from the share price of the underlying shares. If price goes up, option is worth more. It allows the holder to protect themselves against declines in the market value of their underlying shares, but also allows the holder to participate in increases in the share value without having to own the actual shares. It's not because they have an option that they're actually holding the shares. What does it say here? Doesn't mean that the underlying has been transferred at the contract date or even when the contract matures. So when you have options and warrants, you have the right to not exercise your right to buy the shares. So you can say like, okay, I was holding the derivative, but now we're at maturity date and I don't really want to buy the share, so I'm just going to let it go. So you don't have to buy the underlying of the contract. Purchase option. So if you took 308, you probably remember call and put options. Those are derivatives. And options, basically they're going to pay a fee to gain the right to do something. And whereas that's for purchase options, whereas written options, the company writes the option and it charges a fair premium and gives the holder the right to do something. So you always have more risk when you're the writer than the purchaser, because you're the one that's you have like no control because you gave the right to the holder of it. But all of this is not really necessary for you guys to know for the exam. Unless you're taking 308 at the same time, then I guess you should learn it. So how are you going to account for them? When the options and warrants are going to be issued, the holder is going to create a financial asset in their books, and they're going to credit their cash amount that they paid. And the writer, on the other side, they're going to record a liability. So see, it's a financial instrument because the holder has an asset and the writer has a liability. And every time that the fair value of the derivative changes, you're going to want to account for it in your books. So if the derivative loses value, you're going to want to book a loss. And if it gains value, you're going to want to record a gain. And for the writer, is the opposite. If the derivative gains in value, for them it's a loss. And if the derivative loses in value, for them it's the gain, because it's the reverse, because they don't want to pay whatever it is that the derivative gives the holder. At the exercise date, so if the holder is like, okay, let me exercise my right for my options, this is the journal entry you're going to do. So you're going to record, if it was, for example, to buy shares, you're going to record an investment in whatever shares you have, and it's going to be the number of shares on the option times the market price. You're going to also remove your derivative from your book, and that's going to be at the book value. You're going to credit cash for the amount that they actually paid. So it's going to be the number of shares on option times the strike price. And so you're going to result in a loss or a gain depending on the difference between the market price and the strike price. For the writer, at exercise date, they're going to have to go and they're going to receive the cash from the holder to buy the shares, and they're going to remove the liability, but it's going to be the same amount. Oh, sorry, it's going to be like accounts payable. Your liability derivative is going to be in the second journal entry, because the writer is going to go and have to go buy the shares on the market at the actual price. So they're probably going to book a loss if the market price is higher than the strike price, and they're going to book a gain if it's lower. If the holder is like, I don't want to buy the shares anymore, I just want to cash my option. So they're going to receive cash amount by the number of shares times the difference between the market price and the strike price. They're going to remove their derivative from their books, and they're going to plug a gain or loss. And for the writer, they're going to pay the same amount to the holder. They're going to remove the liability from their books, and they're going to plug a loss or a gain. That was for options and warrants. You can also have forward contracts, where the difference between that and options, for example, is that forward contract, you have to do something in the future. Whereas options, you have the choice whether you wanted to exercise your right or not. Forward contract, you're actually going to do it, but it's accounting for the same, it's accounted for the same way as options. So you're going to record that fair value, and gain or loss is recorded through P&L. For convertible bond, convertible bonds are basically bonds that also holds, that the holder of the bonds can also decide to convert the bonds into preferred shares, let's say, or common shares. So they can say, okay, on that date, I want to give you back my bonds. I don't want to earn coupon, like interest cash at each period. And instead, I want to get the shares. Because you have a liability, which is your bonds, and you're also going to have an equity portion, which is your potential common shares. You're going to have two accounts to account for. You're going to have to account for your bonds, and you're also going to have to account for the conversion of the potential shares. And these are valued separately. So how it's going to work is you're going to have your cash. You're normally going to pay a little bit more because you're going to have conversion rights. So your cash is the amount that you pay. Bonds payable is still the same as before, is the issue price of the debt, like we saw in chapter 14. And then you're going to have the difference between the two, and that difference is going to go in contributed surplus conversion rights. You might also get warrants in these type of problems, and the warrants are going to also be valued separately, and you're going to have contributed surplus warrants, for example, and that's going to be for the amount of the warrants that is given in the problem. Normally, it's the number of warrants per bonds times the strike price. If they convert their bond into common shares, they're going to remove the bonds payable from their books because they don't have to pay anymore, and they're going to issue their common shares. The common shares amount is going to be a plug. You don't use the market rate of the common shares. It's going to be a plug with your contributed surplus conversion rights. So if they convert 100% of their bonds, then it's going to be the 100% amount of your contributed surplus conversion rate. If it's only a person that's converted, then you only do these amount times the percentage that they use to convert. If there's no exercise of conversion at the end of the contract, you want to remove your bonds payable, remove your contributed surplus, and then you plug your cash amount. If the bonds are converted early, so before the date that is said on the contract, how you're going to assign it is that first you're going to do the market value minus the book value of book value, market value of the debt. So the difference between the market value of the bond minus the book value of the bonds, and that's going to go in your debt retirement cost. And if you still have, if your transaction doesn't balance still then that difference is going to go in retained earnings. And under IFRS, the entire payment is a loss. So you're not going to have debt retirement costs or retained earning. It just goes directly loss on retirement. That's going to be for the cash amount. And that's it for the theory. So let's jump into the any questions on theory again? Okay. So convertible bonds. ABC Limited issued $501,000 8% 10-year convertible bonds on January 1st, 2021 at 95. The bonds were dated January 1st, 2021. Interest is payable on December 31st, 2021. Each bonds are convertible into 15 common shares, each trading at $20. ABC Limited has decided to issue detachable stock warrants at the rate of 12 warrants for each bond. Each warrant allows the holder to purchase one common shares at $50. Similar warrants are being traded at $2 each. If the bonds weren't convertible and didn't have warrants, they will have sold for $92. ABC uses ASPE and records both liability and equity components. The amortization of bond premium or discount is done using the straight line method. All right, so first, prepare the entry to record the issuance transaction January 1st, 2021. So we want to recognize the liability portion and also the equity portion. And there's also warrants in this problem. So we want to recognize the warrants separately. So first, we're going to have our cash. We're going to have our bonds payable, contributed surplus warrants, and contributed surplus conversion rate. I'm going to be back in like 2 minutes. You guys can try and do this transaction while I'm gone. It's going to be real quick. Okay, sorry about that. I'm back. So did anyone figure out what was the cash amount for the transaction? Can write it in the chat or yeah, that's right. So how did Jonathan get the 475,000? Basically, they say that the convertible bond were issued at 95. So that means that they were they paid like the bondholders paid 95% of the maturity values for the bonds. So how do we find the maturity value? It's going to be 500 bonds times $1,000. And then you're going to take 95% of that. How did you find the bonds payable amount? Is it given? Did anyone find it? So the bonds payable amount is going to be, so since we're valuing the liability separately from the contributed surplus, the problem has to tell you like at how much would the bonds would have sold like alone. Here to tell you that if the bonds were convertible and didn't have warrants, it would have sold for 92. So that means that they would have sold for 92% of 500,000, 92% of their maturity value. Like that is 460,000. Then we want to find the contributed surplus for their warrants. And the info that we have on the warrants is that so there's 12 warrants for each bond. And each warrant allows the holder to purchase one common share at $50. And similar warrants are being traded at $2 each. So first we want to find the number of warrants that we have. So it is 12 times 500 bonds. And the value is going to be the market value of the warrants. So they're being traded at $2, so the market value is 2. We're not using the strike price here to value the warrants. We're really using like their market value. And then the contributed surplus is just going to be a plug amount. So you're going to do your debits minus your credits. So here are the 95% of 500K. Here I did 92% of 500K. Here I did 12 warrants times 500 bonds times $2. I assume that on December 31st, 2022, 45% of the warrants holders exercise their options. Prepare the applicable journal entries on December 31st, 2022. So here is the exercise of warrants. We want to find first how many warrants we have in total. And we did kind of find it earlier. The number of total warrants that they have is 12 warrants times 500 bonds. So in total, there's 6,000 warrants. Then 45% of that amount is 2,700. So there was 2,700 warrants that were exercised. So you want to reduce your warrants balance by 2,700 warrants. We want to find what was the cash proceeds from exercising those warrants. So each of these warrants allow the holder to purchase one common shares at $50. So that means that the company is going to receive $50 for each warrant that was exercised, and then they're going to issue their common shares. So that means that it was $50 times the 2,700. So that's their cash proceeds. And so the journal entry is going to be cash for the amount that they received. You're going to have your contributed surplus warrant that you want to reduce by 45%. It's going to be 45% of the amount that we booked on January 1st, 2021. And then we're going to issue common shares as a plug. So we're not using the market value of the shares. We're just using, we're just doing a plug. For D, how many shares have been issued from the bond convert? Oh, sorry. C, assume that on July 1st, 2023, 10% of the bondholders exercised their options to convert the bonds into common shares. Common shares were traded at $30. Prepare the appropriate journal entries on July 1st, 2023. So we first want, because it's about convertible bonds, we want to find what is the book value of the bonds on July 1st, 2023. So the future value of the bond, and they're using something important, they're using the straight line method. So that's going to make it a lot easier to find what the book value is. So we're going to first find the difference between our maturity value and our issue price of the bond. So the maturity value was 500,000, and the issue price was 460,000. That is a difference of 40K. They were issued for 10 years. So that means that the amortization amount at each period is 4,000. So we're on July 1st, 2023. So that means that on January 1st, 2022, the book value was 460 plus 4,000. On January 1st, 2023, the book value was 464 plus 4,000. And then on July 1st, 2033, so 6 months have passed. So January, February, March, April, May, June. So we're going to want to amortize the bonds for $2,000 to account for half of the year. So it's going to be 168,000 plus the 4,000 times 6/12. Then 10% of the bond holders exercise their options. So we're going to find what is 10% of 470,000. And also the 10% of the conversion rights, because we're going to need it for the journal entry, is 300. So my journal entry, we're going to remove 10% of the bonds payable, so 47,000. We're going to remove 10% of the contributed surplus conversion rights. That's going to be $300. And the rest is issued on common shares. And it's just going to be the sum of both. So 47,300. So here we didn't use the market rate to find the value of the common shares. We really it's just a plug amount. And then here they're asking us how many shares have been issued from the bond conversion on July 1st, 2023. And then you can use your market rate and basically do your common shares divided by the market rate. of $30. And that gives us 1,577 shares per issue. Questions on convertible debt, because you're definitely getting a problem on that. Yes, Jonathan.
Sorry again, how did you get 1,577?
Yes, I did my book value of the common shares divided by the market rate.
Which is
$30. It was given in the question.
Oh, okay. Is that a market rate? Isn't that just the market price?
Yes, market price. Sorry, I got confused on my word, but yeah, it's the price at which the shares are trading on the market on July 1st.
Thanks.
And finally, last question. It's about options and how to value it down. So ABC purchased a call option on Tesla common shares on September 5th, 2021 for $570. The call option gives the right to ABC to buy 653 shares at $25. The option expires on March 1st, 2022. The following dates are available with respect to the call option. So we have September 30th, the fair value and the market price of the shares. And then they're asking us to do the journal entry on September 5th, September 30th, December 31st, March 1st if the call option expires, and March 1st if ABC exercises its call option. So first, on September 5th, they're going to want to recognize their financial asset. So they're going to have their call option, that's a financial asset, and cash for the amount that they paid, so $570. So they purchased it for $570. Then on September 30th, they want to have the value in their book on September 30th at the fair value of the option. So they want in their book their financial asset to have a book value of 250. 250 is lower than 570, so they're going to have a loss. And they're going to reduce the value of the call option. The amount that we want to have here is the amount that brings us down to a book value of 250. So it's going to be the difference between 570 and 250. So now my book value is, well, on September 1st, it was set 570. And now September 30th, I'm taking the 570 and I'm reducing it by 320. My book value is now 250, which is the same as the fair value of the option, which is what we want. Then on December 31st, 2021, the fair value of the option goes down again. So we're gonna again recognize the loss. And now we want to bring it the value down to $100. So to do that, we need to reduce it by 150. So if I do my 250 from before minus my 150, I get a book value of $100, which is my fair value of the option on that date. And then on March 1st, if the option expires, we want to remove it from our books. So we're gonna do another loss of $100, so the book value comes to 0. So then my book value is at 0. But if they decide to exercise the right, Then they're gonna have an investment in a company, which is Tesla. That investment is gonna be of 653 shares, because they bought 653 shares, times the market rate, because the investment is always at the market rate. So it's going to be times $31 per share, which is the market price of the Tesla shares on March 1st. They're going to remove from their books the call option, which is now at $100. So imagine that this didn't happen for this transaction. So the book value is of $100. They're going to pay cash 653 shares times the strike price. The strike price was $25. And then they're going to book a gain because they actually paid less than the market price. So the gain is going to be your debit minus your credit. So let me just put here market price times number of shares, book value, and then strike price times number of shares. Okay. This is probably going to come up as like a multiple choice question. Normally your long questions, there's going to be one on convertible, there's going to be one on long-term debt, there's going to be one on arrow, there's going to be one on any of the chapter 13 situation that we've seen, but like more detail. Normally there's 4, if my memory is correct, and the rest is on multiple choice. And then multiple choice are more math-based than theory-based. They're not going to ask you for the definition of financial liability. Well, I think they might, but I'm pretty certain that they won't. And I think Trevor is the one in charge of the class, so you don't have the other one that was normally there for the fall. So I find his exams very fair and very like he's not trying to trick you. So if you're doing like the practice problems and you're practicing a little bit of the past exams, you're gonna do fine. And that's it for the tutorial. Any questions on anything relating to the class or the exam? Or to go back to go see